Well, Laurence Balanco is with us of CLSA. He's, of course, one of the most sort of keenly watched technicians out there. Laurence, great to have you. Good morning. Thanks very much. You know, I did see what you said on the 7th of this month. This is, of course, after the results came through. And you were basically looking at the big market sort of bull phases we've had. You looked at the 2000 to 2000 and sort of that period, starting about, I think, 2003 onwards. Then the GFC, then you looked at the next move all the way till 2020, the COVID fall, and then this one. And your basic thesis was that the uptrend is intact, Laurence. So why don't you sort of contextualize for our viewers what we've seen last week with the big volatility? Has that changed anything at all? And what would markers for you be?
Yeah, I mean, so from the longer term side, you know, the idea behind that piece was just to illustrate that longer term trend that you've seen develop off the COVID lows is still very much intact. And to put it into historic comparison, you know, the bull phases that you had from 2001 into 2008, you know, that was a 600-odd% gain for Nifty. Then it was followed by the 2009 to 2019 gain, which was over 450%. So, you know, on that longer term trajectory, end of this decade, we're talking about targets between 30 and 37,000. So that's the longer term sort of runway that we're looking for the Nifty at the end of the day. But, you know, in the shorter term side, it's been quite a frustrating move from February, because every marginal new high that we've seen the Nifty set, it's been followed by a short, sharp sell-off. And, you know, the election results sort of played into that. It's the biggest sort of intraday decline that we've had since the 21st of January, being just over 6%. But it's also, you know, comparing it to the 2004 election results reaction, the 2019 reaction, you know, this is the quickest recovery of that initial decline that you saw from of 6% last week. So added volatility, but it doesn't change the longer term outlook on what we've seen for those trends in the market.
Okay, so Laurence, hi, good morning. So outline that longer term trend once again for us, and the targets and the levels that you'd look at, since you think that this whole roller coaster doesn't change it.
That's right. I mean, we didn't violate any longer term trends, being the 200-day or 200-week moving average. And you know, we're talking about these decade-long trends that you've seen in the Nifty from that 2001 low. So, you know, to put into perspective, end of this decade, that's where that 30,000 to 37,000 upside target is based off those trends that we see now. And then the shorter term side, 21,100 is the 200-day. And on an intraday basis, that's what we got close to on the reaction to the results last week.
Could you just repeat the Nifty target, Laurence? I think I heard you say 30,000. These are long-term targets, right? If you could just repeat them.
Yes, so that's end of the decade, right? End of this decade.
End of the decade.
Between 30 to 37,000. Those are the targets that we're looking at.
And something a little more near-term for us. So we got that. Those are big numbers. End of the decade targets. 30,000 to 37. You know, we're 5 years off, actually. It's not that bad. It's not that long off. But anyway, 30 to 37,000 on the index. That's end of the decade. And maybe slightly more near term?
Yeah, so, I mean, like we've said on a number of times on the interviews that we've had before, we think we're in the consolidation period here where the upside's sort of limited to this 23,700 to 23,800. So that's the shorter term upside potential. And really the level that we're sort of highlighting as where you accumulate or rebuild positions here is on volatility and corrections back towards the 21,000 area.
Hi, Laurence. Good morning and good to see you. I don't know, I would expect the Nifty to be at the higher end of that range, 30 to 37,000 at the end of the decade, going by the kind of momentum that you've seen and the way the markets have been moving. But we take your point, 30 to 37,000 on that. Give us a couple of levels that we're looking at in terms of, the global cues. The dollar index, the yields as well have popped up a little bit in the last few days. And both those two, they're important for an emerging market like India.
Yep, totally. So if you look at the dollar index, pretty straightforward. After that decline of 10% that you had off the September 22 highs, dollar index very much been range bound between 99 and 100. That's basically been the bottom end of the trading range for the past 18 months. And the top end's been sitting at that 106 to 107 area. And, we're sitting around 104. So very much towards the upper end of that trading range, but we're not seeing any dynamic set up for an ultimate breakout. And if anything, if we look at the longer term profile that we have for that dollar index, this trading range, which is in a lower level than the peaks that we made in September 2022, we think is part of a downtrend developing in that dollar index, but in the near term, clearly dominated by that trading range setup. And then as far as yields go, we did see quite a big reversal on Friday. For the 10-year yield in the US, we're basically looking at a trading range between 4.33 being the bottom end and 4.70 being the top end of that trading range.
Laurence, just clarifying one more point. When you were talking about more sort of near-term Nifty targets, you said 23,800 is the level that you're watching out for. And that's over what sort of a time span?
Well, that's a short-term time horizon. So we're looking at that over the next month.
Next month or so. Okay.
Yep.
Laurence, let's talk, maybe sectors if you can, or sort of more specific areas of the Indian market that look strong to you.
Yeah, man, so it's quite interesting, with the coalition government, a lot of stories that we've seen is, PSUs, you want to start rotating out of them. From a chart perspective, we've seen major breakouts within that PSU space. The index, if you look at the broader PSU index, that is, since 2008 to 2023 had been in this broad cyclical trading range. We broke out in 2023, and we still think there's still significant upside for that index of over 60%. So we think that's a space that you can still accumulate in. If you want to get more specific, PSU banks is still in that uptrend. And if you look at the relative chart of PSU banks versus the broader banks index, the re-rating that you've had from the 2020 COVID lows has only retraced half of the decade-long downtrend the PSU banks have traced out versus the private sector banks. So PSU banks, PSUs in general, we think is still a leadership space. If you're looking at the defensive sectors in fast-moving consumer goods, as well as the pharmaceutical side, interesting post the election results, we've seen pharmaceuticals break out. So that is our preference to the fast-moving consumer goods, which have just got to the top end of the range and started to roll over. So prefer pharmaceuticals over FMCG.
Laurence, if you want to go with specific names, most welcome to. Say 3, 4, 5 top ideas, on a secular basis, which you think are, which will make a lot of money.
Unfortunately, I have to stick to the sector overviews rather than the stock specific. So if you go back to that PSU basket, I think that's still a space that you want to be accumulating in. Going forward and using the volatility that we're looking at between that 21,000 and 23,000 level on the Nifty on pullbacks to accumulate in that space. And if you want to be more defensive, obviously the pharmaceutical space we prefer. And just to remain underweight FMCG as well as IT. We've seen a bounce in IT, but if you look at that relative to the Nifty, that's failed below the 200-day, and that still maintains its relative underperformance. Maybe one more point that I'll add to the IT side. If you look at software names across the globe or a broader software sector, you've seen a significant rollover the past 6 months and a breakdown from a topping pattern. So we do see, software names globally looking quite vulnerable. And I'd put the IT service names in India, part of that basket of stocks, IT stocks globally that are in downtrends and still remaining weak.
What about crude, Laurence? It's been well behaved from our perspective, and we've seen that there's been this melt up in metals. But for us, we are tracking crude, and we're happy to see that one still hasn't made it to that $90, $95, $100 per barrel mark. Levels you're tracking on that one?
That's right. I mean, it's very much like the dollar index been in a trading range for about 18 months, where the bottom of that range is $70 to $71, and the top of that range at 99 to 100. So we'd have seen, a bounce Monday session of roughly 3%, but that basically leaves oil at the midpoint of its trading range. So we're not seeing any imminent breakouts on the energy side.
Okay, and Laurence, before we let you go, maybe an outlook on the U.S. market itself. Every day is a new high for the U.S. indices. Do you see that continuing? What about these magnificent 7 stocks?
Yeah, but it's a point that we made in our recent note that, for the first time since the October 2022 lows, the percentage of stocks above the 200-day has actually fallen, and it's down to 62%, while the Nasdaq's made new all-time highs. Now, that's not a great timing tool, but what it does suggest to us is that, the move's getting more concentrated, and that's normally a sign of maturity. So again, just singling out that software side, which has really rolled over and broken down relative to the semiconductor names, which is driven by the AR theme, remaining strong momentum trends, but it's getting far more selective, which is typically a sign of maturity. So yes, we're in an uptrend there, but you need to get more selective as this trend develops from here.
Laurence, a savvy investor who's watching you live right now has just messaged me saying that 30,000 by the end of by 2030 is going to be underperformance.
Very disappointing.
So
that's why I said I'm leaning towards 37.
It's got to be 37.
It would be the smallest advance of those decades that are broken down, right? It would be 300% to 350%, whereas the 2008 to 2019 was a 450%, and obviously the 2001 to 2008, that was a 650%. So in that terms, as a trend matures, it typically does slow down. But I think 30 to 37,000 relative to some of the other emerging markets that you're looking at, you should be quite happy with that.
Fair enough. Tempering our expectations there, Laurence. Good talking to you today. Thank you so much for joining in. Great chat as always.